Good evening, class, and welcome to our advanced taxation class for tonight. Today, we are taking taxation of business part 4. We are looking at past question paper so that we test our knowledge of commencement rules, change of accounting date, and cessation. Now, let's go to skills past question, taxation question, November 22, question number 2. Now, this is the question that we are having in focus here. Mr. Zachary Incorporated on October 2000, sorry, October 2016. Now, this incorporation date, this date of incorporation is not important for us. You know why? Because our date of incorporation has nothing to do with taxation and when the business commences. Now, it did not, but the company did not commence business until March 2017. So our date of commencement, so I will come here and say date of commencement is March 1, 2017. All right, March 1, 2017. The company prepares its audited financial statements to February 28 every year. So account year end is 28th February. The first account year end will be 28th February 2018. Okay. All right. That's when the first accounting period will be. However, disruption of business activities arising from the COVID-19 pandemic, company ceased business on April 30, 2020. So I'll come here and say date of cessation. That's 30th April 2020. So somebody says, I can't hear you clearly. Can somebody confirm if you can hear me clearly now? Madam Mercy, you can hear me clearly? Can you now confirm that you can hear me now clearly? Others, please, can you confirm that? Can somebody confirm? Please, let's confirm so that I can continue the class. Okay, and I need to change my headset. Just a moment. I need to change my headset. Somebody say slightly better. Another person say I can hear you. Let me change my headsets.
Hello, I cannot hear you.
Spectrum, I can't hear anything though.
Can hear me now, right?
Okay.
I agree now that you can hear me because I'm no longer using earpiece. I'm no longer using anything. So I
Yes, I can
believe
hear you.
you can hear me now.
Yes,
Yeah,
very clear.
Now,
yes.
basis period for the relevant year of assessment. Now, what is the relevant years of assessment? You see here that because the account ended in 2020 April, for year of cessation, what happened? This is date of cessation is April 30, 2020. You will now say due date to file cessation tax. Open a bracket, 6 months after cessation date. So 6 months after cessation date is when? We have April, May, June, July, August, September, October. So April, May, June, July, August, September, October. So it will be October 30, 2020. All right. So because the due date to file is ending in 2020, it means the year of cessation is 2020. So what it means is that cessation year is 2020. If cessation year is 2020, normally it should start from March 1, 2018 to February. See, February, they used to end their accounting date, February 28. February 28, 2019. Now, this one is the PYB. Then we have another one that will start from March 1, 2019 down to February 28, 2020. This is another PYB. Then we also have March 1, 2020 down to 30th of April 2020. So this is the relevant years. These are the relevant years. So what you will come here and say year of assessment, basis period, filing due dates. Let's take the first thing. Let's leave the year of assessment first and do the basis period. We have 1st of March 2018 to 28th of February 2019. So February, March, April, May, June, July, August. So the due date for filing will be August 30th. August 31st, 2019. Okay. Then we have March 1st, 2019 to 28th of February 2020. The due date for filing will be August 31, 2020. Then we have another one, March 1, 2020 to the date this business ceased, 30th of April, 2020. So we have April, May, June, July, August, September, October. So this will be October 30, 2020. Now, having done that, come to the year of assessment. Because the due date for filing is 2019, this is 2019 year of assessment. And this is 2020. This is also 2020.
Please, I have a
Right.
question.
Then the
Please, I
next
have a
question
question.
will be
Hello, Chima.
assessable profit for the relevant assessment year. So assessable profits. Come here and use this. Assessable profits. So I will start year of assessment, basis, period, assessable profits. So this should be 2019. This should be 2020. I might decide to use one date for 2020. I might decide to use two. I prefer to use two for sake of simplicity.
(2021). This one will be 0103. Mr. Chima.
So this is for copy and paste. We just copied these two things. So what do we do now? We will go to the question. This is
Hello, Mr. Chima.
year ended February 28, 2019. Do we have it there? February 28, 2019. The assessable profit is 20 million.
Hello.
So this is 20 million.
Hello, Mr. Chima. Can you hear me?
Then the next one will be year ended February 28, 2020. We have it here, 5 million. 5 million. Then we have the other one there is 100,000.
Hello, sir. Oh, can you hear me?
Another group of people might just say, they might just combine these two 2020 and they will just put one basis period that will cover from March 1, 2019 all down to April 2020. And they will combine it as 5,100,000. Well, I wouldn't want to do that. I want to follow them in process like this. So this is the answer to this question. Now let's see whether we can take a cue from what they solved. So this is question number 2. Wow. It's in 21. Cessation. 2019, 2020, 2021.
Mr. Chima,
2019.
can you hear me?
Note that if the company have ceased business on any day July 1, 2022, the year of cessation would have been 2022. I don't agree with this answer. But it's fine. They are saying here that this is 2019. I might tend to agree with them that this is 2019 because it's preceding year basis. But from what we learned, it is the due date that determines the year of cessation. But it's okay. We can do it the way I can want us to do it. This is 2020. This is 2020. This is 2020 because preceding year basis. This is also 2021. This is also 2021. It's fine. It's fine.
It's fine, okay.
So it means it is contradicting
Hello,
what
Mr. Chima.
we said the last time. So, but what we've just seen from ICANN's past question here is where the due dates, where the accounting period ends, it has to be followed by preceding year basis. So it's fine. So based on preceding year basis, like we've learned, this is correct. But from what we did in cessation, we learned that it is the filing due date, the year the filing due date was. That is what determines. But let me see. Okay. I think I was the one who made the mistake.
Yes, yeah.
This is 2020 October. And I wrote it here. It's supposed to be 2020. Well,
2021.
2021. It's fine. 2021 year of assessment. It's fine. Let's look at another question. Let's see if
This
Mr.
one is not
Chima.
clear now.
here is
Mr.
past
Chima.
paper that
Please, can you
This
hear
one is
me?
not
Can you
clear
hear
yet too.
me?
this topic. Let's see. Question 4, question 3. So this question does not qualify. Okay. Somebody's hand. Right, so the new topic for today is capital allowances. Now with capital allowances, you are going to be understanding what we did in our basis period more clearly. So because basis period questions are not tested in isolation, they always go ahead with capital allowances, loss relief. Now, we are going to be looking at the types of capital allowances. You'll be seeing things like initial allowance. You'll be seeing annual allowance, investment allowance, rural investment allowance, balancing allowance. You'll be seeing all of these. Then you'll see something balancing charge. Then we look at the restrictions in capital allowances. And these are the main things that we are going to be doing. All right, so let's go now to the basis of this topic. Now, provision for capital allowance is contained in the second schedule to the Company Income Tax Act. Now, capital allowance is granted in lieu of depreciation. What does that mean? It means that instead of allowing you to use your accounting depreciation in your tax determination, the taxman will rather want you to use capital allowance. Now, what is depreciation? Depreciation is the written off of an asset over the useful life. You buy a phone or you buy a laptop and you intend to use the laptop for 4 years. If you buy the laptop for 500,000, each year you want it to be on straight line basis. That means each year 125,000 naira is written off, that this is what has been used out from the assets due to like wear and tear and all that. And that's another way. If you are saving that money or providing for depreciation, it means that at the end of 4 years, you would have gotten enough money to buy a new one. Secondly, it is as though the government is allowing you to recoup the money, that you spent in your assets back. Because for them to say, okay, depreciation, write it off. It means you bought this, let's say your car, 10 million, and use it for 4 years. It's 2.5 million. Government is saying for every year, write off 2.5 from your account. It's as good as government saying, take 2.5, we are giving you back 2.5. After 4 years, we would have given you back the whole assets, the value of the money you spent in the assets. But now the problem is this. There are several methods of calculating depreciation. We have straight line depreciation. We have reducing balance depreciation, sum of digits. Now, it is not consistent. So when you are looking at depreciation is an estimate, accounting estimate, and these tax people will say that these methods are not consistent. The financial accountants can use straight line for the first and maybe a second year, and we'll say, okay, no, to achieve our aim next year, we'll change to reducing balance. They are not consistent. Secondly, the useful life of an asset is not fixed. For example, a car can be bought and a company will say, this car, will use it for 4 years. That same car can be bought in another company and they will say, no, ours is for 3 years. And now the person that is doing 4 years might decide to use straight line. The one doing 3 years can still do straight line. The same value of the car, the same day they were bought from the same person, different depreciation. Another person might say, okay, I still bought the same car and I will still use 4 years. But instead of straight line depreciation, I will use reducing balance. Different answers. And so for consistency, the tax authorities say that instead of using depreciation, which is subject to frequent methods, different lifespan that the company can just choose and also change their, estimate anytime, the taxman gives you capital allowance. Capital allowances reduces all taxpayer to a common base as the rate. So it means that for capital allowance, all assets have, similar assets have the same useful life. So it is not somebody will now use 5 years for his vehicle, another person is using 4, another person is using 3. No, the same. Then there is also the same rate. Not somebody using straight line, another person is using reducing balance. So they are using the same rate. All right. Now, what is the capital allowance? Capital allowance are a form of relief granted to any company which incurred qualifying capital expenditure. So the keyword here is, I'll be underlining the keyword, is a form of relief, because by relief, it means you need to deduct it to reduce your tax. So it's a relief. When they say it's a relief, it means your your income, you must deduct these capital allowances to reduce the exposure to tax. Now, it is granted to any company which incurred qualifying capital expenditure. So it must be a capital purchase. It must not be a recurrent revenue expenditure. What we mean by revenue expenditure, we mean operations. So it must be a capital nature. A capital asset is an asset whose enjoyment is lasting over 1 year. Now, it is granted for qualifying expenditure obtained or acquired during a basis period. Now, when we say qualifying capital expenditure, it must be under property, plant, and equipment. We call it PPE. If it is not PPE, you will not get capital allowance. Now, the thing again is in use at the end of the basis period. So it means that the capital allowance, the asset must be the company's property and they are being used as at the end of the accounting period. So it means that if you've sold the asset, you can't be claiming capital allowance as at the end of the basis period. The asset must be the capital asset of the company as at the end, and they must be using it for business purpose, not personal. Capital allowances are granted in lieu of depreciation, and depreciation is usually disallowed. So one of the disallowable expenditure is depreciation. One of the allowable expenditure is capital allowances. Now, there are 3 or 4 types of capital allowances. One of them is the initial allowance. I will call it IA. Then we have the annual allowance, or call it AA. We have balancing allowance, or call it BA. Now, the opposite is balancing charge. I can call it BC. Then we have investment allowance. I'll call it INA. Or I can call it INF-A. INF-A, to make it different from IA. All right, so let's talk about this. What is initial allowance? Initial allowance is the capital allowance that is granted to a qualifying capital expenditure in the first year of acquisition of the assets, in the case of new or second hand. But when we are talking about building, there is an exception. Now, what we are saying here is this. Initial allowance is the first allowance you give to an asset, to a PPE, in the year the asset was, in the first year of acquisition of the assets, in the first year of acquisition of the assets. So it means that if you bought a car, in the first year of assessment, you must grant initial allowance. Initial allowance is always granted in full. Granted in full. Never prorated, irrespective of the number of months in use. Now, let's say your car, you have a car and the initial allowance is 50%. Your accounting year ends in 31st December, and you bought the car January 1 of a particular year. Maybe you bought the car 10 million. 5 million, which is 50%, will go as initial allowance for that year it is put into use. that first year. Now you bought that car in January 1, you will still collect the 5 million. You bought that car, maybe it's not January 1, you bought it again, it is in June 1 or July 1, just 6 months to go. You will still use 50%. Assuming you bought it December 30th, only one day that it was put to use, you will still deduct the 50%, which is 5 million. Let me usually give an example that I used to give. If you are registering for ICANN and you got your registration number, let's say December 30th, 2024. What happens? The moment they give you their registration number, even if it is for one day, 30th of December or 31st December, you have incurred a debt of subscription and development levy for that first year. So your first year of a studentship is 2024, even if you are a student for one day. By 2025 January, a new bill is set for you. So you will be saying, why didn't you prorate 2024? Because it's one day. No, they don't prorate. Whether your capital asset is bought on the first day of the basis period or on the last day of the basis period, the full amount is deducted. Now we go to annual allowance. Annual allowance is granted annually or yearly and is computed on the balance after the deduction of initial allowance. So it means here that annual allowance is costs minus initial allowance. When you have deducted the initial allowance first, then you will now divide it by the useful life. Useful life. All right? And this is always prorated. It is always prorated. Now let's see an example now. Let's see this example here. You bought an asset. Let's use here. You bought an asset. Cost of assets, let's say it's 10 million. This PPE. Okay. Now, initial allowance is 50%. And we are told that annual allowance is 25%. Now the question is required. Determine the useful life of the assets. That's number A. Number B is what is the annual allowance if the accounting year end is 31st December 2020 and the assets was bought on 1 January 1, 2020, number 2, July 1, 2020, and number 3, December 1, 2020. Sorry, 2020. So that's the question. So what do we do? Start our solution here. We are asked to look for the useful life. Now, useful life of an asset is equal to 100% over annual allowance percent. So in this case, we have 100 divided by 25. We have 100 divided by 25. So the percent cancel the percent. So 25 cancel itself here 1, 25 cancel here 4. So I will say N, which is useful life, equals to 4 years. So you see that because it is 4 years, that's why you are taking 25% each year. 25% the first year, 25% the second year, third year, 40. So capital allowances is using, the annual allowance is straight line, it's like a straight line allowance, but it is prorated. So you can see that this is for 4 years. It means that year 1, year 2, year 3, year 4, that is when you are permitted to take capital allowance. After year 4, you can no longer collect capital allowance on that asset. Now we've answered the first part. The B part says we have to determine the annual allowance. Okay, so for us to determine the annual allowance, we must first of all know initial allowance. So determine annual allowance. How do we determine that? How do we determine that? We will now say I would like to call this one now. Capital allowances. Okay. Sorry. I would not say annual allowances for the assets is cost minus initial allowance. Now divided by the number of years. Right? Now it will not be all of this multiplied by M over N. Okay, M over 12. M over 12. M over 12. All right, I will explain what is M over 12. M is the number of months that the asset has been put into use. Why 12? is the number of months in a normal basis period. N is the number of useful life of the asset. So let's do them one by one. So you will now say A, okay, you will now say 1. Assets was bought on January 1. So it means that M is how many months? From January to December, M is 12, right? And of course, your N is how many? 4. 4 years. We've determined that. All right? So your annual allowance will now be, the cost is 10 million. Okay? The cost is 10 million. The cost is 10 million. And we are told that initial allowance is 50%. So this is, the cost is 10 million minus initial allowance is 50% of 10 million. Now divided by 4 years. Now multiplied by 12/12. Multiplied by 12/12. All right, let's do them one by one. We have your AAs here. This is your 10 million, which is still your costs. 50% of 10 million is 5 million. Now you are going to divide this thing by 4 years. Now, normally 12/12 is still there. So what happened here is 10 million minus 5 million will give me 5 million. Now divided by 4 years. So now this is 5 million, which is cost minus initial allowance. So this 5 million is what will be shared for the 4 years. That is what will be shared in the 4 years. Now, 12/12 here means if you cancel out, because it is 1 full year, you're not prorating. So 5 million over 4 will be 120. Let's see, 1.25. 5 million divided by 4, that will give me 1,250,000. So that is 1,250,000. That is the normal annual allowance. This is your normal annual allowance. So for assets that was bought in January 1, we'll simply say times 12/12 to cancel out is still 125,000. For assets bought on July 1, you will now say M is 6. So this will now mean 1,250, which we have established as the normal annual allowance, multiplied by 6/12. So this will cancel here 1, this will cancel here 2. It means for the first year, the very first year, you'll be dividing this 125, you divide it by 2 to give me 625. That will give me 625,000. Now, this will only apply to the first year because the first year, you only use 6 months out of a 12 months basis period. Only 6 months was used. But for the second year, you use 12 months. You use the whole 1,250. For the third year, you use the whole 1,250. For the last year, you will use the whole 1,250 and the fraction that was removed in the first year, you add it to the last year and deduct 10 naira because you must leave 10 naira in your books as long as the asset is with you. We'll see a question on that. Now for assets bought on December 1. Now M is 1. So it's same as saying 1,250 times 1/12. So you are dividing it 1/12 because it's only 1 month in the basis period you used it. So it simply means this. Okay, sorry, that's not it. 1,250 divided by 12. That is 104,167. 104,167. And that is for the first year only. For the second year, where you'll be using the full year, the full basis period, you're going to use the full capital allowance. The third and the fourth, you use this full and you bring the fraction that was not taken here in the first year. So that 11 months you didn't take, you bring it to the last year, but you leave 10 naira. So that's how it goes. We'll be seeing questions on that. Now, we have investment allowance. What is investment allowance? In addition to initial allowance, there's an asset called investment allowance that can be claimed in respect of only plant and machinery out of all your PPE. Of course, you know that PPE contains your land and buildings, motor vehicle, office equipment, furnitures and fittings, and also plant and machinery. All of these form your PPE. All these PPE suffers initial allowance. They also enjoy, initial allowance. They also enjoy annual allowance. But when it comes to investment allowance, only plant and machinery out of the PPE enjoys investment allowance. And now the rate is 10% on the cost of the qualifying expenditure. Now, you see now, investment allowance is only charged once, just like initial allowance. So the principle of initial allowance apply to investment allowance. They're only charged once. They are not prorated. But the difference here is that investment allowance is not to be deducted from the cost of the assets. So what it means is that investment allowance is just an additional allowance that is given to them. It is not deducted from the cost, unlike initial allowance that would deduct initial allowance from cost to get annual allowance. If we want to calculate our annual allowance, you must calculate your initial allowance. You calculate your investment allowance, but you will never deduct investment allowance from cost. Only initial allowance should be deducted from costs before arriving at your tax written down value on which your annual allowance is based on. Right. We'll now go to rural investment allowance. This is another type of investment allowance. Now, rural investment allowance is different from investment allowance. Investment allowance is granted to plants and machinery, whereas rural investment allowance is an incentive granted to taxpayers that locates its business not less than 20 kilometers away from facilities that are usually provided by government. So if your facilities is located more than 20 kilometers away from electricity, let's say there is no electricity, no water, no tarred road, and you are located more than 20 kilometers from those facilities. There is none. Those three things, I call them EWT. 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 Or I can change it to WET, wet. So I can come and say wet, this is 30, this is 15, and this, sorry, this is 30, this is 50, and this is 15. I can call it wet. We are creating the acronyms ourselves. 30, 50, 30, 50, and 15. Now, if your facilities are 200 kilometers away from wet, it means there is no facility at all. All the money you spent on providing this facility, all the expenditure you spend in providing those facilities for your business, you are going to get 100% of investment allowance given back to you. So it means that rural investment allowance will not be deducted. It will be calculated as an additional capital allowance. We call it like JARA. It will never be deducted from costs. So imagine you spend 10 million and you are giving 10 million as your investment allowance. You still need to calculate initial allowance from the 10 million, which is 5% like we did, and it's 5 million. So you have two allowances now, 10 million on one hand, investment allowance, 5 million is there, and your initial allowance will be calculated. Unlike investment allowance, which is for only plants and machinery, you are calculating 10% one side, 5% one side, then you remove the initial allowance from the cost to get the amount that is used as initial annual allowance. Now, assuming that it's only electricity that is not available, there is a tarred road, there is water, but it's just only electricity that you don't have, is 50%. So 50% is claimable if you don't have electricity. Now, if there is no tarred road, or maybe there's electricity and no, there's no water, but there's electricity and tarred road, you are going to claim 30%. 30%. Now, if there is there's no tarred road, but there's electricity and water, you're only going to claim 15%. Now, what if there is no water and no tarred road? You will claim 30% for water plus 15% for tarred road, making it 45%. So this 30 and this 15 will add. If it is only electricity and water that are not there, but there is tarred road, you will claim 80%. But if all of them are there, you have 50, 30, that's 80 plus 15, that's 95%. But because you have sighted your this thing away 20 kilometers, you only benefit from 5% that is being, that is not, you only benefit from 5%. So if there is everything, you cannot charge this 50, you cannot charge this 30, you cannot charge 15. So it's just 5%. But sometimes they don't even allow you to charge because there's facilities as though, so the 200 kilometers might not even matter. 20 kilometers might not matter, I mean, because you have all these facilities. There are good tarred road that you can pass. There is water, there's electricity. All right. Characteristics of investment allowance, I've mentioned them, so no need to talk about it again. Now let's go to balancing allowance and balancing charge. Now, what is balancing allowance? Like the name implies, it is a capital allowance item. Balancing allowance. So it means it's a balance. When we talk about balancing allowance and balancing charge, we are talking about a situation where you sold the asset before the useful life. Let's take, for example, you bought a motor vehicle. This motor vehicle has a useful life of 4 years. That's 25% annual allowance and 50% initial allowance. Of course, no investment allowance is claimable of this because this is not a plant and machinery. This is a motor vehicle. Now you've calculated your first year initial allowance, your first year annual allowance, and it is for 4 years. You've claimed the first year, you claimed the second year. In the third year, you now sold the assets. Now, like in our example that we are doing now, your tax written down value, let's say your tax written down value means, okay, let's use a practical example. Let's use a practical example. Let's use a practical example. Now, going by this example, okay, let's say a plant and machinery was bought on July 1, 2020 for 10 million naira. The account year end is 31st December every year. Okay. So Initial allowance is 50%. Annual allowance is 25%. I will open IE, N, which is our useful life, is 4 years. Investment allowance is 10%, because this is a PM, right? Now, assets was disposed on let's say August, let's say September 30th, 2023. So that is when the asset was disposed of. Okay. Find the balancing charge or allowance if the cash received on disposal is 2 million. Okay, so let's go. We have our solution here. So how do we do that? We have to calculate this let's do something here. Costs. Cost of assets is 10 million, right? Initial allowance. Okay. I might want to calculate, yes, initial allowance, or I might want to calculate, to be on the safe side, I always calculate investment allowance first. So I want you to adopt that. Anyone that qualifies for investment allowance, calculate it first. Investment allowance, we say is 10%. So what we'll do here is 10 over 100 times 10 million. So that will be 1 million. So this is your capital allowance. So this is your, for the first year. So this is the first year. So let me put it down here. The first year of assessment. So year of assessment, when was it bought? It was bought in 2020. So the year of assessment will be 2021. 2021. The basis period will be January 1 to December 2020, because, so this is January 1, 2020 to 31st December 2020. So that's your basis period. Now this is the first year the asset was being put into use, your investment allowance is 1 million. It does not affect the cost. That is what we just said. Then your initial allowance, we say, is 50% of 10 million. 50% of 10 million is going to be what? 5 million. So can you see now, because I'm putting it down here, it is going to affect this cost. I'm also going to put it down here because it is also a capital allowance. It's a capital allowance we are calculating for this same year. We have calculated the investment allowance, which does not affect the cost. So it was not put down here, put straight in capital allowance. Annual allowance is going to affect, investment allowance is going to affect the cost. So why it is going to be put in brackets here to be deducted from cost, it's also a capital allowance that should be calculated. So this is your tax written down value, which is also called net book value if you are doing accounting. This one is normally called net book value. For tax, it's called tax written down value. It means 10 million minus 5 million will give me 5 million. It is this 5 million that is available for annual allowance. So you come down, annual allowance. Annual allowance is this 5 million you have here. 5 million divided by 4 years, which we know. Now, how many years, how many months is used in the basis period? Because this asset was bought on July 1. So we would have used it for July, August, September, October, November, December. So it's 6 months. So, but look at what I'm going to do. I'm not going to do the prorating now. So, 4 divided by 4, that gives you 1,250. So which will say 1,250,000. Okay. For year 1, it's going to give me 1,250,000 over 12 because we use it for 6 months. So times 6 divided by 625. So my 625,000 will be here. 625,000 will be here. So, but here I'm going to put it as bracket because I'm removing this value. So what happened? Let's calculate your capital allowance for the first year. 5 million, 1 million, 6 million, 6 million, 625. So this is 6 million, 625. So this is your total capital allowance for the year, right? Now, because you are going to the next year, you are going to do your tax written down value. So your tax written down value is, what is the balance? This one has been done. So we have 5 million down here. Let me shift it from this place so that I'll be seeing my book. We have 5 million. $625,000. So this is going to give me 4,375,000. 4. So this is 4,375,000. So this is the tax written down value that you are carrying to 2020, the next year of assessment, which is 2022. So you say 2022. The basis period is going to be January 1, 21 to 31st December 21. Okay. All right. Now, you come again. Tax written down value. It is 4,375,000. Of course, you will no longer charge an investment allowance because it's charged once on the first year. You will also not charge initial allowance because it is also charged once in the first year. But you are going to charge, so you come here and say annual allowance. Your annual allowance is going to be 12/12 because you use the full months. In the first year, it's only 6 months from July to December. The second year, you started from January to December. So no prorating. You are going to be using 1,250. So I'll come here and I'll say 1,250. And here is 1,250. So this is your capital allowance for the year. Only one capital allowance is claimed. Then let's look at this now. We are minusing 1,250. 3.12 million. 3.12. So this is 3,125,000. So this is going to be your tax written down value. Okay, so this, sorry. So this year has ended just the way this other one ended. Now the third one, we are going because on the year it is disposed. So year of assessment, which one is this now? This is 2023. 2023. Of course, the asset has 4 years useful life, and this is the third year. It's going to be from January 1, 2022 to 31st December 2022. When did you sell that asset? You sold the asset on what date? September 30th, 2023. So this is not it. Basis period is 2022. Okay. You have your tax written down value. 3,125,000. 3,125,000. Yeah, let me do something here. Let me adjust this question to say, so that I will not be going, instead of writing 2023, let me change it to 2022. Let me change it to 2022 so that we just go 2022 September 30th. Okay, so 2022 September 30th fall in year of assessment 2023. So now your annual allowance is from, this is 1,250. Now, how many months did you use it? From January to September is 9 months. So you're going to claim only 9 out of 12 months. So you can't claim all these. So this is for 12 months. You're only going to claim 9 months, January to September. So what you will do now is, let me bring a second calculator. 1, 2, sorry. 1, 2, divided by 12. That means 937,500. 937,500. So I'll come here. 937,500. I'll write it down here. 937,500. So what you do, you look for your tax written down value. Tax written down value. You come now. Let's take this one. 3,125 minus 937,500. That will give me 2,187,500. 2,187,500. Written down value. You see now, your tax written down value is 2,175,000. If you have not sold the assets on September 30th, if you didn't sell the assets, in the long run, government is going to give you all these 2,175,000. But now, you went to sell the asset for 2 million. You will now say cash proceed. Sold it for 2 million. Now, whenever your tax written down value is bigger than your cash proceed, it means what you have collected is less than what you would have claimed if you didn't sell it. If you didn't sell it for 2 million, in the long run, you would have collected 2,187,500. But because you hurriedly sold it for 2 million, the cash proceed is smaller. So this is going to be 187,500. This is going to be your balancing charge. No, balancing allowance. It's going to be your balancing allowance because you have collected 2 million already. This is the balance that the government is going to give you in that year of assessment that, okay, we promise we are going to give you all your assets, but now you've sold it, it's no longer with you. You have recovered 2 million. All right? We are going to give you 175 as balancing allowance. So it's going to give me the total capital allowance will now be, total capital allowance will be 9,375 plus 187,500. That will give me 1,125,000. 1,125,000. I mean 1,125,000. So this is going to be your capital allowance. And your capital allowance includes your annual allowance here and your balancing allowance. Okay. Now, assuming that he sold it for 3 million. Okay, let's do another assumption. assume that the assets was sold for 3M on September 30th, 2022. Okay, so what will happen? If the asset was sold like that, what will happen? We would have calculated our, just that year, tax written down value 312,500. So we would have said year of assessment 2023. Basis period is January 1, 2022 to 31st December 2022. We would have come here, tax written down value 3,125,000. Then annual allowance, this is 9 months, is going to be 1,250,000 times 9/12, and we said it was 937,500. 937,500. We put it in bracket because we less it. Then I'll come here. This is our capital allowance. It's going to be 937,500. Okay. You are now getting your tax written down value. We said it was 2,187,500. 2,087,500. Then this is our cash proceed. Is going to be 3 million. Now, when your cash proceed is more than your tax written down value, so what will happen now is this. So we have 2,187,500. Now you are minusing 3 million from it. You are saying that if you didn't sell it, government would have eventually give you 2,187,500. But now you went to sell it for 3 million, more than what you should have gotten. The difference of 82, see it's in bracket, 812,500. 812,500. So that is going to be your balancing charge. Balancing charge. So what happened to balancing charge? It reduces the capital allowances you are going to claim. Either you use it to reduce your balancing capital allowance you claim, or you add it to your available, accessible profits that you are going to collect tax from. So it means that this 812,500 is going to be taxed because you have made additional income because you sold this car at 3 million. So you see here, it is reducing your capital allowance. The amount you are using to reduce your profits is now lower by 812,500 because this is a balancing charge. So you see, I have put it in brackets here. If it is a balancing allowance, I would have added it, but it's a balancing charge. So what will happen now is, let's do it now. 312,500 937 500 now minus 812 500. It means effectively their capital allowance is 125,000. So so you use 125,000 as your capital allowance. Now, you can decide to do it in two ways. You can decide to use 937,500 as your capital allowance, but this 812,500 will add to your assessable profits. So that way you are still getting the same value. Right? So that's it for explaining the balancing allowance and balancing charge. So where the sales value of an asset is less than the tax written down value. So we check it here. When you have your tax written down value, you have your sales proceed. So if your tax written down value is greater, okay, it's lesser, it's greater. If your tax written down value is greater than sales proceed, you have balancing allowance. But balancing charge is when your tax written down value is greater than sales proceed. So balancing charge, balancing allowance, you always determine your tax written down value first, and then see whether it is smaller than your sales proceed. If it is smaller, you have balancing charge. If it is bigger, you have a balancing allowance. All right. Now, capital allowance rates and restrictions under SITA. Okay. That will be our subject for the next class. So it means capital allowance part 1 ends here. So this is capital. Okay, this is part 1. All right, part 1 ends here. Part 1 ends here. So in part 1, what have we done? We're able to define capital allowance and why it is used instead of depreciation. We now saw different capital allowances. We saw investment allowance, which we said is given just once, and it is reducing the cost to arrive at a tax written down value. We also have investment allowance, which is only on plants and machinery. The rate is always 10%, and it is given as an additional capital allowance that is not prorated, just like just like initial allowance, not prorated. But the thing is, it also does not affect the cost to determine tax written down value. Then we have the rural investment allowance, which we discussed. We have the principle of wet, no water, and we said it's going to be 50%. 30% rather. W wet is 30%. Electricity is going to be 50%. And third road is going to be 15%. We mentioned it. All right, then we also now look at annual allowance. And we say annual allowance is granted in the first year of use, and it is being prorated according to how many number of months the asset was put into use. So it only normally affects the first year and perhaps the last year of the asset's useful life. Then we also talked about balancing allowance, which is the allowance that is supposed to be balanced to you by the tax authority or government when you sell your asset before its useful life at a lower amount from your tax written down value. Now, the inverse is the case if you sold it more than the amount in the tax written down value, the excess becomes a balancing charge. At this point in time, I would like to see if anyone has a question, because the class has ended. If anyone has a question, let him speak. So there is no hand. I can't see any hand. So part 1 of capital allowance has ended. In part 2, we take something higher than this. And in part 3, of course, is going to be much more higher. So with that, we come to the end of today's class. Come to the end of today's class. And the recording of this class will be sent to you either today or tomorrow. So also is the AI companion. The summary will be sent to you. If you have any question, feel free to ask me on the WhatsApp, and I'm going to provide answers for you. So thank you so much, Madam Mercy and Madam Patricia, for joining the call. I also thank Madam Tosi and Madam Janet for also joining this call. And Madam Benita, thank you also for being present. Until we see you again in the next class, where we'll start part 2.
Thank you. Thank you, sir.